Hi everyone, I'm Dr. Lizz, your lecturer, and today we are going to look at three topics. There is introduction to accounting, the 5 group of accounts, and also the accounting equation. Okay, so bear with me, let's go. First, we look at what is accounting. So if you are new, I'm sure you don't know what accounting is, except that it deals with calculation, it deals with money. Okay, so accounting is the process of identifying, measuring, recording of business transactions or events in monetary terms, and then communicating the financial information to the interested parties. We look it into a little bit of a detail, and so we want to look at what is actually the business transaction. You have to understand this first before we can proceed. Business transactions or events here are activities that are happening in the business. So that is business transactions. So this is what you need to record, to identify, to measure. Okay, so that is what makes the accounting process. So what are business transactions? Here I list several business transactions, as you can see, like number 1, you sell goods to customers for 2,000. So this is a business transactions that you have to record. Okay, you pay for utility bills. You pay for the utility bills, the water, the electricity, then you need to record this. Okay, number 3, you pay the salaries to your workers. When you pay the salary to your workers, you need to record them. You purchase goods to be sold. Okay, this is you purchase goods to be sold. And then you purchase the office equipment that you need to use in your business, and then you need to pay for the supplier, and then you pay the monthly bank loan for the loan that has been approved. You pay the monthly rental. The owner took goods for 500 ringgit, but for personal use. Should you record it in your business book or what? And the last one, another example is when the owner bought a car for his personal use using his personal money, then do you record this in the business book of accounts? So now you understand about the business transactions, the activities that take place in a business that has got to be recorded in the accounting books of the business, so that at the end of the period we are going to be able to calculate the profit or loss that the business make. Okay, so these are the examples of the business transactions that we have looked at. Okay, so now we are going to see in detail what is identifying. Okay, so now we are going to look at the first one, identify. Now, what is identifying? This is identifying from our definition of accounting. So identifying is actually, you will need to identify what is to be recorded. Okay, the business transactions just now, what is to be recorded and what not to be recorded, where to record it, and which group of accounts does it belong to. So you need to identify this before you can properly record it. Referring to these business transactions, let's see which has got to be recorded and which is not to be recorded. Okay, so the rule of thumb is that if it involves the business, you do it for the purpose of the business, then the transactions has got to be recorded in the book of business. Okay, so number 1, you sell goods to customers. This is of course your business transaction, so you have to record it. When you pay for utility bills, of course it is for the business purpose and you use the business money. You pay salary to workers, again this is the business transaction which has got to be recorded. Purchase goods to be sold, again from the business for the business. Purchase office equipment, again from the business for the business. But then if we look at number 9, owner took goods for personal use, means that you take the business good but it is for personal use. So do you have to record it? The answer is yes. Why? Because the goods that you take is the business goods, but then for personal use, then this is what we consider as a drawing. Okay, the drawing that the owner take from the business from his personal use. And then number 10, the owner bought a car for his personal use using his personal money. So you can see the car for his personal use, but he used personal money, not the business money. So of course, this is not considered as a business transaction. So this one will not go into the books of accounts of a business. So now you have seen what is identifying. It deals with identifying what business transactions needs to be recorded and what are not to be recorded. Where do you record it and which group of accounts does it belong to? That one we will go in a little bit later. Next, we will talk about measuring. As you can see, that accounting is also the process of measuring. So, what is measuring? So as you can see, I have a picture of money here. Okay, so here measuring means you are going to record the items that can only be measured in monetary term. For example, in Malaysia, you use ringgit Malaysia as our currency. So all transactions here must be recorded in RM. Okay, for example, for each transactions that we have here, we have all the monetary values attached to the transactions. So because of this, we only measure transactions that can only be recorded in monetary term. So for example, if you are an IT specialist and you open up a business in IT service, so we cannot put your expertise in value, and because of that we cannot record your expertise as one of the business transactions. Next is the recording. Okay, so recording is all the identified items, the business transactions must be recorded continuously in the correct accounts. So just now you have identified which are the transactions should be recorded and then which are not to be recorded, and then after that you have already measured what to be recorded in the RM or in the monetary value, and then after that you can proceed with the recording of the business transactions. And so where do we record them? In the correct accounts. So what are the correct accounts? We are going to look at that after this. Okay, and the record must be continuously, means that every time the transaction occur, then you just have to record it every day until the year end, and then you will start again for the new period. Then the accounting records that has been done at this stage will produce the financial statement. Okay, so in the financial statement, this is where it will show you how much is the profit or loss that the business has made. So this is why we do the financial statement, because we want to see the profit or loss that the business has made for that particular year. Okay, and the financial statement here will be used by the users. So this is what we mean by communicating. Okay, so communicating means the users of the financial statement will use the financial statement for different purposes. So this is where we look at the category of the users. So we have the internal users and also the external users. The internal users, for example, are people in the organization itself, like the managers, the board of directors, the owners, or the employees. And for the external users are people who are outside of the organization, for example, the investors, the bankers, the government agency like the income tax people, and also the public. So this is what communication is all about. Okay, so now I hope that you can understand what is the meaning of accounting. We continue with our next subtopic, which is what are the 5 groups of accounts. Now, once you have already identified which transactions are to be recorded and which transactions are not to be recorded, then you will need to identify where to record them. Okay, so that is why you will need to learn about the 5 groups of accounts, because all transactions that has occurred in the business will be recorded under any of the 5 groups of account. So you will have to classify this transaction belong to which group of account. Okay, the first one is what we call the owner's equity. So owner's equity is actually the capital or the resources contributed by the owner. That is the amount of investment made by the owner. For example, how much cash does the owner contribute to the business? Or what are other assets the owner brings into the business so that he can start his business? So this is what we call capital. Okay, so this is the capital brought in by the owner into the business so that the owner can use it in his business. So it can be either cash or it can also be either in the form of assets. For example, he can bring in his computer, he can bring in his motor vehicle, furniture, machineries, or whatever into the business so that he can use it in the business. Okay, so over the years, the business is operated, then at the end of it, we will calculate the profit that will earned. Let's say you get some profit. So the owner's equity will increase by the amount of the profit earned by the business. However, in the case that the business is incurring losses, then it will be reduced by the losses that the business suffer. Okay, and then in the end we have the drawings. So what is the drawing? Drawing is actually you take the business money or the business asset, for example the inventory that you want to sell to your customers, but you use it for your personal purpose, so we call it drawings. Okay, so whatever drawings that the owner has made during the year will have to be minus from the capital so that you will get the owner's equity. Okay, so as you can see, whatever the owner bring into the business, it can be in the form of money, it can be in the form of asset, and also whatever the business earn as profit will be added to the capital. And then if there is any drawings made by the owner, that is using the business money or business inventory for his own purpose, then it will be regarded as a drawing and need to be minus from the capital. So this is what we mean by owner's equity. That is whatever the owner brings into the business plus with whatever the profit the business earn, and also minus with the drawing that the owner has made from the business. However, owner's equity can be easily referred to just the capital. Okay, so some people don't say owner's equity, but we say capital. So when we say capital, then it is understood that it is actually the owner's equity or the capital brought in plus the profit earned minus with other the drawings made. Okay, so this is the first group of accounts that we have, which is the owner's equity, or known as capital. Okay, now business will use the capital brought in to buy the assets or to pay for other expenses that need to be paid so that you can run the business. Okay, but then the capitals brought in by the owner might be not enough to buy all the assets required and to pay all the expenses necessary to start the business. So what we need will be the business will start to borrow the money. So this is what we call liabilities. Okay, so liabilities are actually a fund supplied by the external parties to the business so that the business can buy more assets, also to pay for whatever expenses that they need to operate the business. Okay, so when you have a liability, means that the business has an obligation to pay. Okay, because you are making maybe a bank loan. This is the example of liability, the bank loan or bank overdraft. Okay, or the accounts payable, or known as the creditors to the business. So account payable are actually when you buy things on credit. You don't straight away pay the supplier. So we call them account payable. So you are owing your supplier some money. So this is a liability. So there are two types of liability. Okay, there is what we call non-current liabilities, which are the liabilities that can be paid in more than 1 year. If you can pay it in more than 1 year, then it is called non-current liabilities. But if you need to settle the payment in less than 1 year, then we call it current liabilities. Okay, so we have non-current liabilities if the maturing obligation is more than 1 year, but we have current liabilities if it is only less than 1 year to pay to meet its maturity term. Okay, class. So now we have owner's equity, which is your own money that you bring into the business, and also the liability, which is the the external fund that you bring in to fund your business. Okay, using the liability and also the owner equity here, then we can start buying our asset. We can start buying our asset. Okay, so now let's see what we have here. You can buy your asset. You can buy the shop lot. Okay, your shop. Or you can buy the office equipment. This is the office equipment. That is why you need the capital and you need the liability. You can also buy the furnitures and fittings. Look at that. The furnitures and fittings that we have in a business. The tables, the chairs, the furnitures, the rack and everything. And also the machineries that you might have bought. The motor vehicles in case you need to use one in your business. So these are all the assets that you have to buy so that you can run your business. Without these assets, you cannot run your business. Okay, if you still have some more left, then maybe you want to invest some money in any investment fund that you can find. Okay, and then you will also need to hold some money in the form of cash in your hand, because you will need to pay this thing, you need to pay for that. So you will need to hold some cash in your hand. And then you will need to keep some inventory, to buy some inventory. This is your inventory, because these are the things that you need so that you can sell your inventory. Okay, and then some cash will also be put away in the bank account. And then there will be some account receivables. Account receivables are actually the account that is created when your customer buy the goods from you, but then they do not pay immediately. So they buy goods on credit. So you sell the goods to them on credit. So that is what we call account receivables. Okay, so these are actually the assets that your business can have. If you can see here, we can see that asset here consists of shop lot, office furniture, machineries, and everything. And here, as you can see, these are the things that cannot move. Okay, this is not mobile, or you say that you cannot move. So this is what we non-current asset. Okay, so we call it non-current asset. So these are the assets that you need to use in your business from year to year, from day to day, so that you can operate the business. And this is the investment kept for more than 1 year. Okay, if you put your money in the bank, but you cannot take it away within 1 year, more than 1 year, so we call it investment. Okay, and then after that, as you can see here, we have cash, inventory, bank, account receivables. These are the items that can be easily converted into cash. So this is what we call the current asset. So as you can see here, assets can be divided into 3 here, which are the non-current asset, investment, and also the current asset. We have another asset which we call as intangible asset, and these intangible assets are assets that you cannot see, you cannot touch. For example, like the goodwill, like the trademark or patent. Okay, so these are your assets. Now we are going to see how we are going to put this together. That is your 3 groups of account here, which are your asset, and then your owner's equity, and your liability, and then we can form the accounting equation. Nice, isn't it? Okay, let's see. This is the accounting equation. So as you can see just now, when we have owner's equity, here, plus with the liabilities, then you will get the assets. Do you see that? So we have here whatever capital that you brought into the business plus whatever external fund that you might have taken from outside, then you can actually has what we call the asset here. Okay, so this is the asset. So asset is equal to owner's equity plus liability. I hope you can see that. So what we have now is asset equal to owner's equity plus liability, because whatever you brought into the business and whatever external fund that you get from bank, for example, will always be equal to the asset that you have, either in the form of non-current asset, investment, current asset, or intangible asset. So that's how we come to get the accounting equations. So this is your first accounting equation, which is asset equal to capital plus liability. So I hope that you can see now how do we derive the first accounting equation, which is what we call the basic accounting equation. So this is the basic accounting equation. Always remember that asset will always be equal to capital plus liability. Remember when we talk about profit just now, the profit earned in your owner's equity. Okay, so where do you get the profit? Okay, always remember the formula. The profit earned can be generated from using this formula, which is revenue minus with expenses. So this is how you get the profit. Okay, so we are going to look closer into these two groups of account, which are the revenue and also the expenses. First, we look at the revenue. Now, what is revenue? Now, revenues are whatever income that you generate from your operation. Okay, what is the main source of revenue? It can come from the sales. Of course, it will come from the sales. So this is the main source of your revenue. Okay, you must make a sale so that you can ensure that you can get higher profit. So the higher the sales will be, the higher the profit. Okay, but you can also receive revenues from other sources, like the commission that you receive, or the interest that you receive, or the dividend that you receive. So there will be other sources of revenues also besides these three. Okay, then we look at the expenses. So what are the expenses? Expenses are actually what you need to incur in order to run your business. So there are two types of expenses, which is revenue expenses and also capital expenses. Revenue expenditure or operating expenditure are those that you need to incur so that you can operate the business. For example, the purchases that you have to make, the salaries that you have to pay, the utilities, the rental, advertising expenses, maintenance, carriage, or if you have to incur some bad debts, that is, you cannot collect the debt from your customers, then it becomes one of your expenses. And also, if you need to pay the loan, remember we take a loan just now, so the interest that you have to pay on the loan will become the interest on loan, which is an expenses to your business. Okay, so these are the operating expenses, so we call it operating expenses. So another type of expenses will be the capital expenses or capital expenditure, which are the expenditure incurred so that you can acquire your fixed asset or non-current asset. Okay, so now when we have revenues minus with the expenses here, then you will get either profit or you will get a loss. If your revenue is more than your expenses, then you will get the profit. But if your revenue is less than your expenses, then you will get a loss. Okay? So now we can see that profit earned here is dependent on revenue and expenses. So now we want to include all groups of account here. As you can see now, we already have 5 groups of account. Number 1 is owner's equity. Number 2 that we have is the liabilities. Number 3 is asset. Number 4 is revenue. And number 5 is the expenses. So now we have 5 groups of accounts. So when we want to include all these 5, then we can have a new accounting equation. So as you can see, this is another accounting equation that we can have, which is asset plus with expenses plus with drawings. You remember the drawings that we have here? Okay, plus the drawings will be equal to capital plus with liability plus with revenue. So this is what we call the expanded equation, and here is what we call the basic equation. So now you can see that you have 2 accounting equation, which is the basic equation and also the expanded equation that consists of all 5 groups of account and also the drawings up here. Okay, so now this is about all for the topic of accounting equation and the 5 groups of account. So I hope that you can understand that and you can do the exercises now. So until next time, please listen to the video carefully and repeat it again if you cannot understand. I'll see you again for another topic. Thank you so much.